Okay, today we're going to be learning about the accounting cycle. Okay, why do we want to learn about the accounting cycle? The reason is the accounting cycle is what allows us to take a lot of different information, a lot of data, a lot of information, and turning it into a meaningful financial report. So if you think about H&R Block, this is a service company. If you look at the third bullet point, it says it had a retail office within 5 miles of most Americans.
This means there are a lot of H&R Block offices.
Inside of each of those offices, we've got clients coming in. We're preparing tax returns for them. We pay maybe office rent for the space. We pay utilities expense. We pay taxes. We pay our employees for their salaries. A lot of transactions are happening every day, all across America and even in some other countries. So we're going to take all that data and eventually turn it into financial statements, such as this one. This is H&R Block's 2014 income statement. If you look at total revenues, it says that the revenues were $2,999,460,000. So we had to categorize and summarize all of the different locations' revenues, make it on this one report. And for expenses, we had field wages, other wages, and some marketing and advertising wages, some depreciation, some bad debt, all these different expenses that we had to summarize to be able to report to the financial statements. Alright, so the accounting cycle is how we do this. It's going to start off with analyzing these transactions. And then it's gonna, if you look down at the bottom, you can see that we're gonna prepare financial statements. And then at the end of it is where we get the accounts ready for the next period to start the whole process over again. So this is step 1 through 10, the accounting cycle. So let's take each step individually. The first one says transactions are analyzed and recorded in the journal. So the transaction, for example, H&R Block prepared the corporate tax return. The analysis, what is the financial impact? Well, we received cash and we earned revenue. So the two accounts affected would be cash and service revenue. We would record this in a journal where cash increased by $6.99 and service revenue increased by $6.99. And we would do this with debits and credits, which we learned in Chapter 2. And remember, I provided you a video that reviewed how to use debits and credits, so make sure you continue to review the journal entry debits and credits. Okay, so let's look at more of this terminology in step 1. We're talking about a journal. What exactly do we mean? Well, so if I was thinking about a journal for myself, it would be like kind of like a diary or something like this, or you may have what I really like to use is what I call a prayer journal, where I write out my prayers, or I also have what I call a prayer board. So I write my prayers out. So that's kind of what I think of when I think of a journal. So looking at this, May 28th, today I woke up and I took the dogs out. Then I made coffee, I cooked breakfast, and fed the dogs and kid. I don't know why this little Facebook thing is up. I don't even use that on here. So just look over that. But this is what a journal will look like. It has the date and it tells what I did that day. So this is what a journal entry would look like for H&R Block. It would have the date, but it would be what I did financially. For example, on May 28th, I had cash that went up by $6.99 and revenue that went up by $6.99. So a journal entry is just a listing of transactions that happened to that company. Let's look at step number 2. Transactions are posted to the ledger. So this is your journal entry at the top. The journal is a listing of transactions, and then we're going to post those to the ledger. Posting just means copying it to the accounts. The reason that we do this is because we need to find out how much is in each account. So this is what we mean by posting. I'm gonna copy that $699. I'm gonna do that. I did that for you on a post-it note. Copy it out of that journal, and I'm gonna copy it to the account or the bucket. So I'm going to place it into that cash account. I'm going to place it into that bucket. I'm going to place it into the cash account because I'm going to have this bucket available to see all the transactions that happen to cash. So I'm going to add them and subtract them all up to know what is inside that account. Now all these buckets together, all these accounts together are called your ledger. I'm going to do the same thing for the credit of that transaction. I'm going to place it into the service revenue account or bucket. There it goes. After I journalize and post, I always have to make sure that I did it correctly, that I put everything in the right bucket, added and subtracted it right. So I do a trial balance. Think of this as I am trying to see if I balance. I'm going to add up all of my debits and all of my credits, see if I'm in balance. This number is the same as this number, so I can see that my debits equal my credits. So I am in balance. So now I'm going to read this bubble. What else has happened this month that I have not accounted for? So if I look at my trial balance so far, I have cash, revenue, expense, capital. But notice the salary expense. I haven't accounted for salary expense. If you look at the picture behind the trial balance, what do those look like? Those are my H&R Block employees. So I'm thinking they have work that I have not paid for them yet. That's one of the adjusting journal entries we learned back in chapter 3. That's the one we're going to use today in this example for this step. So my employees work, but I haven't paid them. In order to see if this is the only journal entry that I haven't made, I can do this optional spreadsheet. I look at the balance before my adjustment. I put in my adjustment. You can see I'm going to increase salary payable and salary expense. That's my adjusting journal entry. And then I can see what my balances look like if I make this adjustment. And even see what my income statement, my balance sheet would look like if I make this adjusting entry. Okay, so step 6, this is what it would look like if I decide I want to make that adjusting journal entry. I'm going to journalize up here, opposed to my ledger. Okay, so this is the same thing as writing down in my journal and then copying it into my buckets. After I journalize and post, the next step is to prepare an adjusted trial balance. Always prepare an adjusted trial balance after we make our adjustments. That is why it's called an adjusted trial balance. So I look at my debits equal my credits, so I'm good. Okay, step 8. Now we're all coming together. Now financial statements can be prepared. We can prepare our financial statements. These are your financial statements: your income statement, statement of owner's equity, balance sheet, and statement of cash flows. I can prepare these for all the transactions I've made this period. And then who's going to look at these financial statements? Who's going to use these? For some examples of our users are our banks. And our banks may be interested because they may be willing to lend us money. Then we have our investors who may be interested in investing in our business. So they would care about the financial health of our company. The government, who may want to find out if we're paying the right amount of taxes. All of these people are going to use our financial statements. Financial statements are covered in chapters 1, 2, and 3, and I will provide the tutorial to help you on the financial statements. I'll add a link in the course for this. Alright, at this point we're basically finished with the financial statements and we're ready to get our books ready for the next period. So this is called closing entries are journalized and posted to the general ledger. So in this situation, this was covered at the beginning of, I believe, chapter 4. So what we're going to do is we're going to close revenue to income summary, close expenses to income summary, and then close income summary to capital. And if we had any drawing, we would close it to capital as well. So we're not going to go over exactly how to do that, but I want you to see the big picture of it. The big picture is if you had a football game and you were to play out your whole game, at the very end you would reset the scoreboard back to 0, and that's what we're going to do. We're going to close our service revenue and our salaries expense by dumping it into capital, starting over so we can find out how much service revenue and salaries expenses for the current period. So that's what the closing means. Since we've journalized and posted, what do we always do after we journalize and post? We prepare trial balance, and this is the post-closing trial balance. It's after we've done the closing entries. Notice it only lists the accounts that we don't close. The permanent accounts, revenues, and expenses disappeared because they have a 0 balance. We don't list those. And again, post-closing trial balance, the word post means after, so it's after we close. And that is steps 1 through 10, the accounting cycle.